As most of you know, I like to start these talks off with a cartoon, and keeping with the Halloween holiday spirit, this is a picture of a vampire without fangs. So if you ever wanted to know what one of these looked like, here you are, suspense is over. And why that is relevant is the big question, one of the big questions impacting the market these days is, what will the market look like without the leadership of the FANG stocks? So Facebook, Amazon, Apple, Netflix, and Google. And you can see the performance of the market in blue with those stocks and in black with those excluded. Those 5 stocks have represented 1/6 of the market's performance since 2016. But changes as of late in the background dynamics of the market have caused some volatility and caused their leadership to come into question. There's been a lot of volatility in the market. I'm sure you all have been watching it, as have I, for the last couple of days. Many reasons why, but it really boils down to the chart on the left there. The 10-year yield has broken out to new highs at 3.2%, levels it hasn't seen since 2011, and that's put significant pressure on the equity markets. That, coupled with some concern that the Fed is going to adopt too hawkish of a posture going forward, and the recently started third quarter's earnings season is not off to the best start, all told, has been causing a lot of volatility on stocks. But it's not all negative. The economic backdrop does continue to remain positive. Corporate earnings in the last quarter were up 25%, and for the rest of this year into next year, earnings continue to look to be quite good. Unemployment at an all-time low of 3.7%, and wage growth continues to be under control. These factors, plus some others, we believe will continue to create a floor to the market. We expect continued volatility, but likely will subside, after the November elections. Turning to life sciences, as I've said in the past, this historically low interest rates have been conducive for risk tolerance, and that has favored companies that are innovative and fast-growing, and that certainly favors the companies in this room today. We've seen generally pretty good market performance across all market cap types of both biotech and medtech. Of note, medtech up 83% and biotech up 28%, and that makes sense. Mid-cap companies, sort of by definition, have achieved some level of de-risking through commercial or clinical success, but still have a lot of upside, so they tend to receive investor dollars in risk-tolerant markets. So 2018, the year of the IPO, for 6 years running now, we've been in a nice new issuance backdrop in the equity markets. There was 55 life sciences IPOs so far this year, almost tackling that of 2014 of 65, and when we're all said and done, if the markets do cooperate, we may get close. Equally important, $6.3 billion of capital has been raised in new issuances this year. We haven't seen those levels at all in the last several years. And equally of note, the average transaction size for IPOs have been $114 million, much bigger than it's been in years past. You wouldn't have this type of IPO activity if they didn't price and trade well. As I said, there were 55 transactions this year. 78% of them priced at or above the midpoint of their filing range, and after one day of trading, they've been up 13%. I get asked all the time, are bankers sandbagging valuations and keeping them low to artificially inflate performance? And the answer is no, we're not. Pre-money valuation for IPOs are $400 million this year, meaningfully above where it's been the last couple of years in the mid $200 million range. So this is legitimately solid performance. But as of late, there's certainly some cause for concern, even before the recent bout of volatility we've seen in the market. There's a lot on this page. I'm going to call your attention first to the blue line on top. That's basically a rolling average of IPO performance. We want to see that around 20%. Anything below that really calls into question the sustainability of the IPO market. And you can certainly see in the October timeframe, the blue line is hugging the index. That's not good. It's not even close to being good. 47% of the IPOs this year are trading below their IPO price at this point. Above their IPO price, meaning 53% have broken issue. We're going to need to see that dramatically improve for the IPO to continue to be a viable financing tool going forward. Shifting to M&A, continues to be a lot of activity across biotech and medtech. MedTech performance has been reasonably consistent, around mid-50s transactions per year. We're on track for that this year also. Transaction size coming in around $200 million. For biotech, we've seen a nice pickup this year in 48 transactions so far, meaningfully above where it's been the last couple of years. transaction size averaging around 555 million. And the real driver there is some of the larger companies continuing to want to expand their portfolio and their pipeline of product candidates. From a trading perspective, it's been a tale of two cities. The black line there signifies the medical device ophthalmology index as we calculate it. It's been up 40% year to date, really driven by two companies that have had stellar performance. Star Surgical up to close to 200%, as well as Glaukos, which has been up around 150%. Biopharma, on the other hand, has suffered a number of clinical setbacks that has really weighed on that index and haven't had a corresponding number of positive developments to offset that negativity. However, despite those mixed sort of results, investor sentiment is still quite positive when it comes to ophthalmology. The bottom line there shows some of the recent IPOs. There's been 6 since 2017, and surprisingly, that's almost as many M&A transactions that we've seen. Usually there's 2 to 3 M&A transactions for every 1 IPO, but that has changed this year with the strong IPO backdrop. Based upon our knowledge of the pipeline, we expect that you'll see a few more IPOs to come out in the coming quarters, obviously if the markets remain somewhat cooperative. And then finally, from an outlook perspective, there's around $450 billion of market cap tied to ophthalmology, publicly traded market cap. Of that market cap, 54% of it have some type of meaningful catalyst coming up in the coming quarters. And you can see how those catalysts correspond to the different development milestones there. Most impactful will be the phase 3 and the approvals. Point being is that we continue to expect a lot of investor interest in ophthalmology going forward. And with that, I am virtually out of time and want to thank you. I appreciate the time today.